So in this lecture, we are going to talk about mutual fund. I'm CA Pravesh Agi. I have, let me introduce myself. I'm a chartered accountant and a graduate from Delhi University. I have worked in industry for 23 years in companies like, Vodafone Idea as the general manager of finance. Grasim Industries, I was a senior manager. Reliance Communication, I was working as a vice president. SRF, I was a chief manager. And then I worked with Hero Group of companies. I was a CFO of one of their company. And finally, I worked in a company called Balatpur Industries, which is a paper industry owned by Thapa Group. Now, apart from teaching experience, when I left my job, I started working with as a guest faculty with the Institute of Chartered Accountants of India, IMT Ghaziabad, Ford School of Management, which is an MBA institute, Shivnadar University, OB Jindal Global University, Bennett University, BM Munjal University, owned by Hero Group, and Institute International Institute of Foreign Trade, or IAFT, Kutab Institutional Area. I'm working as a guest faculty there. So now we are going to talk about what are mutual funds. So we all know that it's a trust that pools the saving of several investors. So basically, it's a form of trust where several investors pool their money and give it to the mutual fund. They invest into different kinds of securities: shares, bonds, debentures, money market instruments, or it can be a combination of any of the above. Now, whatever income which is generated out of these securities in form of capital appreciation or interest or dividend is distributed back among the unit holders in proportion of the numbers they hold, they are held by them. Now, like in a company we have shareholders, but in a mutual fund we call them unit holders, and they own certain number of units as like shares in a company. Now, what is the process? How do the mutual funds make money? Now, let's start with investors. They come together and pool their money with the fund manager of a asset management company who is going to invest into various forms of securities and in form of debentures, bonds, shares, all other kinds of securities, and they are going to generate returns in form of dividends, interest, capital appreciation, and they all form the return of that particular scheme, and then it is passed on back to the investors by way of dividends, or the investors can redeem or sell these mutual funds and make return for themselves. Now, in India, the structure of a mutual fund is like this. First of all, we must know that all these asset management companies in India are regulated by SEBI. So it starts with a sponsor. There's a company who have an idea of starting a asset management company or a mutual fund company. So they first appoint trustees with their board of directors or board of trustees, and the asset management companies is a company which is managed by managers, and they float various schemes, the investment schemes, which generally the unit holders or the unit holders are going to buy these schemes. Now these schemes can be basically equity schemes or debt schemes or hybrid schemes. So we are going to learn about those schemes. The asset management company is supported by various bodies like depositories, registrar, transfer agent, the auditors. So this is the structure of a mutual fund company or an asset management company. This is, the structure of a mutual fund that sponsors, who are basically the promoters of the mutual fund, as I told you. Then there is an asset management company, which is, set up or managed by financial professionals who manage the fund. So asset management company, a set of financial professionals who manage these funds. Then the trustees who supervise the activities of asset management company. Then we have custodians who keep the safe custody of investments. And then finally, we have transfer agents who maintain record of unit holders and provide services like purchase, transfer, and redemption of these schemes. So let's look at the structure. Let's look at an example here. So, for example, HDFC Bank is a sponsor who initiated the idea to set up a mutual fund company in India, which is known as HDFC Mutual Fund. Now, So this is, how the structure of a mutual fund looks like in India. Now, in India, we have so many asset management companies, around 30 to 50 asset management companies we do have in India. And some of them are given on your screen, like ICICI Prudential Mutual Fund, HDFC Mutual Fund, SBI Mutual Fund, Kotak Mahindra Mutual Fund, Motilal Oswal Mutual Fund, Mirae Asset Mutual Fund. Okay, so these are the mutual fund companies, and what do the mutual fund invest in? So that's an important question. So what do mutual fund invest in? Now they invest into, broadly into various securities like money market instruments, which are short duration, bonds in form of CPs, commercial papers, certificate of deposits, repo instruments. So they are very short instruments which carry low interest rate, but they are the least riskiest. Then we have the government securities, which are, like 3 year, 5 year, 10-year bonds or 20-year bond, or even can be 40 years bond. So they give slightly higher rate of interest. And then we have a triple A debt, financially very healthy, like, companies like Reliance, Infosys, Hindustan Unilever, or, HDFC Bank. They are generally, classified as AAA by the credit rating agencies in India, and they carry a higher return, but they are riskier than the government securities. And then we have low rated debt, the companies which have, a rating below a AAA, can go up to right up to triple B, which is the lowest rating, investment grade rating in India. But they come with some kind of a risk, but gives you higher returns. And finally, the most riskiest of all the investment, which is equity shares, but they are risky, but they give you the maximum returns. So the mutual funds, they identify all these options where they're going to invest and generate returns out of these investments. Now, types of mutual funds. So there are, four broad categories of mutual fund. They are based on structure, based on classification of portfolio management, and then based on the investment objective, and then based on the investment portfolio. So the first we are going to talk about based on structure. Now there are two kinds of mutual fund: open-ended mutual funds and close-ended mutual funds. So let's discuss what is open-ended mutual funds. Okay, so let's begin with the first one. So an open-ended mutual fund, it's a scheme that remains open for all the time. Investors can buy or sell into these funds anytime. So that means it is open throughout the year or throughout the, duration of the fund before it closes down. So the investors can, anytime invest into these funds they want, and they can even redeem these funds, or they can, disinvest from these schemes. Now let's talk about open-ended funds. An open-ended fund or a scheme is one that remains open all the time. Investors can buy or sell into the fund anytime. Now, open-ended schemes, are open, and investors, can freely invest anytime they want, or anytime they want to redeem their investments, they can do it. So these schemes do not have any fixed maturity period. So which means that they can, be there for 5 years, 10 years, 15 years before the fund manager decides to close that fund. So the fund corpus is not fixed, which means, people will keep investing, people will, keep redeeming into these funds, and the fund will keep growing. So it doesn't have a fixed corpus. So investors can conveniently buy and sell units at the NAV price, which are declared on a daily basis. So, the mutual fund is going to declare the NAV, the value of, per unit, every day, and the investors can conveniently buy or sell units at this price. The key feature of the open-end scheme is liquidity. That means they offer a great liquidity. So anybody who wants to invest or anybody who wants to exit anytime, he can do so. He can, if a person needs money or an investor needs money, he can just, sell or redeem these mutual funds and cash money out of it. So it offers a great liquidity. It offers a great liquidity to the investors. Now, these funds cannot invest 100% of the funds because of the need to maintain cash reserves to provide the shareholders redemptions in uncertain amounts. Now, these funds cannot invest 100% of their fund because the fund manager has to maintain certain cash reserve because there can be a redemption pressure at times from the public when the market is falling. So people tend to sell these funds and generate exit from these funds. So the fund manager would like to keep some cash in the for exiting from these funds, and of course some cash is also needed to further invest into new kind of opportunities. The portfolio manager needs to be dynamic. He needs to strike a balance on the two things. Should he keep cash for redemptions, or should he invest cash to generate returns for the unit holders? So, he has to maintain a balance that how much cash he should keep for redemptions. Because if we keep more cash, that means there will be a less money, left for investments. Should he invest cash to generate returns for the unit holders? So, how much cash he should keep and how much money he should invest, he has to maintain a balance of that both. The retail investors, they tend to behave in an irrational behavior. They buy when the markets are high and sell when the markets are low. So when the markets are rising, so the retail investors, keep coming to the market and investing into these funds, and thereby pushing up the market. So and whenever the markets fall, so there is always a panic among the retail investors. So they go and sell these or redeem these funds. The fund manager has to do the same thing as well to generate cash when you're selling and invest when you're buying. So the fund manager has to replicate, what the retail investors are doing when they are buying. So and the markets are high, so he buys, the securities at a high price and sell the securities when the securities are falling. So he's actually replicating the behavior of the investors, retail investors. So this means he will buy when the markets are high and sell when the markets are low. But he would ideally like to do the opposite. So it's always better to buy when the markets are falling and to sell when the markets are high, or to book profits. So but he's doing just the opposite of it because of the behavior of the retail investors. Now let's talk about the close-ended schemes. The fund is open for subscription only once, and the corpus is fixed once the issue closes. So these kinds of funds, they open for a particular time, and all the investors would put their money. So and it will open for a week or 10 days, and then it will close down for subscription. So these are called close-ended funds, and then the corpus remains fixed for these funds. Thereafter, they can buy or sell units of the scheme on stock exchange where the units are listed. So, in close-ended fund, the feature is that, these funds cannot be redeemed, on any given day. So, if, an investor has put money into these schemes, so he has only option to go to the stock exchange and sell these units if they are listed on the stock exchange. Close-ended funds are non-redeemable, that is, investors cannot buy or sell into the fund. They have a stipulated maturity period. Now, the fund manager can decide the fund to be of a particular year for a particular period, for example, for 3 years, 5 years, or 10 years. So then the investors are going to get their money only at the end of the maturity period. Investors cannot transact daily. Now, in order to provide an exit route to the investors, some close-ended funds give an option of selling back the units to the mutual fund through periodic repurchase at the NAV related prices. So, there has to be an exit route which has to be provided for the fund manager. So, generally the fund manager will open a window for a week or 10 days where, where the investors, if they need money, they can, redeem these units on that particular window. So as per the SEBI regulations, they stipulate that at least one of the two exit routes is provided to the investor. That is either repurchase facility or through listing on stock exchanges. So the fund manager has to provide either the two window, one that it opens an exit route for the investors at during the period of the during the period of the fund for a week or 10 days, so that people who need money, they want to disinvest, they can redeem these schemes and generate money for them. Or the fund manager has to make sure that these securities or these schemes are listed on the stock exchange, so that the other alternative is that the investor can exit by selling these mutual fund schemes from the stock exchange. Now, these mutual fund schemes don't disclose. Now, of course, these mutual fund schemes disclose NAV generally on a weekly basis. So it's not on a daily basis as in the case of open-ended funds. So these mutual funds, they will disclose their value per unit only on a weekly basis. Now, they have a fixed corpus. As the corpus is fixed, the fund manager is not subject to the vagaries like in open-ended fund. Like here, the fund manager, he knows that he doesn't have to keep enough cash because there will be no redemption pressure only at the time when he opens it, for in an interval, so that people can, the investors can exit from these schemes. Otherwise, he will have, all the money for the entire period of the scheme, and he can remain invested and earn a kind of good return on the investment. So here the 100% of the money is invested, as against an open-ended fund where some portion of the fund is kept for redemptions. So the fund manager knows exactly the cash he has anytime. He can decide when to hold cash, when to invest, thereby using his skills to maximize the returns for the unit holders. So he has has an advantage here compared to the open-ended fund, because he knows how much he can invest. You know, he can almost invest 100% of the money into a scheme, into various kinds of securities, and generate, the money is always at work. 100% of the money is always at work, whereas in open-ended funds, only a certain portion of the money is at work, because the money has to be kept in cash for meeting redemptions. So now we can talk about investment based on investment objective. Basically, what kind of an objective an investor has. Capital appreciation, he wants that his money should grow, or he wants his wealth to grow. And capital preservation, so he doesn't want to lose his capital, but he still wants to make a good amount of money, because when he invests into capital appreciation or the growth scheme, there can be a chance when the market falls, he can lose his capital. So some of the investors don't want that. So they would like to invest in schemes where 100% of the money which they invested is guaranteed, and they make certain amount of money over and above. So it's called the capital preservation. Here, bulk of the money is put into, debentures, which, generate a certain amount of return, so that it preserves the capital of the investor. Then the regular income, it's like a dividend scheme where the fund is going to declare a dividend, so that a person who needs a regular income, apart from his other kind of income which he's making, so he can choose a regular income scheme. Then liquidity. So, like open-ended funds, they offer high liquidity as compared to the closed-ended funds. So, liquidity would be which, funds have a greater liquidity. So, we're going to talk about that. Then the tax savings. If you invest into funds which are called equity-linked saving schemes, which offer a tax exemption under Section 80C of the Income Tax Act up to 1,50,000. So, where you can save tax depending upon your slab rate. So these are based on the investment objective. If your objective is to save tax, then you invest only into those schemes which offer the benefit under Section 80C.